Kia ora, everyone. Welcome to Lunch Money. Before we crack into it, can we get a yes or a thumbs up in the channel if you can hear and see us all okay? We'll wait for some. Can't see any thumbs up so far. Oh, yep.
Yes, Ellie.
Thanks, Ellie. I'll wait for. Yep, cool. Kia ora, Kath. Great. So let's crack into it. So today, welcome to a really special episode of Lunch Money. It's an Australian shares edition. So we recently launched the ability to invest in Australian shares on Sharesies. So now you have access to thousands of companies and exchange-traded funds on the Australian Securities Exchange. So for those of you who are new to Lunch Money, we do these every Thursday at lunchtime. They're available to watch live on video and as well available as a podcast on Spotify, Apple Podcasts, and Google Podcasts after this. So I am Sonya, one of the 3 and co-founders at Sharesies. We've got Gus here, who's our Head of Investments, and today we're joined by our special guest, Scott Phillips, who's the Motley Fool's Chief Investment Officer in Australia. So kia ora, Scott, welcome.
G'day, kia ora.
And so we'll be doing a deep dive into the Australian share market and the economy. So please do get your questions in. If you've got questions for Scott, put them into the Ask a Question button below, and we will go through those in the question and answer section near the end. So before we go, just the legal disclaimer, nothing that we'll talk about today is personalised advice. Investing involves risk, and you aren't guaranteed to make money, and you may lose money. We don't provide personalised advice or recommendations, and any information we provide is general only and current at the time. So please be kind and respectful to our speakers and your other viewers. Otherwise, we'll have to remove you from the webinar. We don't want to have to do that. So just be a good sort. And so now we'll pass over to Gus to introduce Scott.
Hello all. I'd like to, a lot of you might recognize his voice, but yeah, hey Scott, really welcome today. Can you tell us a bit about yourself, like who you are, what's your story, and how you may have gotten to investing?
G'day, Gus, and g'day, Sonia. Thank you for having me, and g'day to everyone watching and listening. We really appreciate being invited on Sharesies. So thank you for letting me join Lunch Money. As you mentioned, Gus, I've got a head for radio and a voice for print, but you're stuck with me anyway, so I'll do my level best. Mate, I've been investing now professionally for 10 years. I joined the Motley Fool in 2011, so literally I've just passed my 10-year anniversary with the Fool. I was employee number 2 here in Australia. We've been in the US since 1993, but here since 2011. So I've turned up there. Before that, I was actually in industry. So I worked for a whole lot of packaged goods companies. Think about the Heinz's or Heinz Waddies, as I should mention for you guys, was called at the time. So it was Heinz Waddies. But people like Diageo, the alcohol company, Goodman Fielder, the baking and consumer goods businesses. And my kind of background was I've done sales and account management. I was an analyst for a while. And then I did a whole lot of roles that were what they broadly call commercial finance. And it was basically supporting the sales and marketing team and being the kind of the strategic voice, the finance voice, the whatever. And it just so turns out that's a really good skill set to have as an investor, because it literally is understanding the dynamics of the market, the competition, your own company, the levers you can pull and push, the things you can change and do. So kind of, you're kind of this internal investor in a lot of ways. What should we do? What should we do differently? How are things going? Which set me up beautifully to be an investor. I was a Motley Fool customer as well of our US business for a long time. And so the opportunity came in early 2011. The Motley Fool's opening up here, and I just literally got lucky, sent an email to our CEO, Tom Gardner, and said, hey, I know you're doing international stuff. If you ever come to Australia, let me know. 3 days later, I got a phone call saying, actually, it turns out we are. We're starting in a couple of months. Do you want to join? So it was a really, really fortuitous circumstance. And as I said, 10 years later, here I am.
Awesome. And for those that don't know the Motley Fool, can you tell us a bit about the Motley Fool and why it's in Australia and the States?
Yeah, sure. I mean, I don't want to do too much of the brand bashing, so I'll try and keep it reasonably quick. But look, basically, the Motley Fool was started by 2 English majors, 2 brothers, Tom and David Gardner. They had an investor father, and they wanted to pretty much break down investing for the average person. In the US jargon, they say, from Wall Street to Main Street. The idea was that things like conference calls, by the way, back then in 1993, were only open to sophisticated or institutional investors. We retail investors weren't allowed in. Brokerage was expensive, research wasn't available, and everyone who said was investing was saying, you can't possibly do it yourself. You need us to do it for you. And the gardeners sort of went, well, hang on, no, we don't think that's right. We think we can do it ourselves. And so the Motley Fool, the very name, come from Shakespeare, as I'm sure your viewers and listeners know. It's from As You Like It. And the Motley Fool is the multicolored court jester in modern English. And the idea was basically he was the only person, it was a he, unfortunately, at the time, who could tell the king the truth without losing his head. And so the whole idea of just speaking truth to power, or just calling it as we see it. No, we've got no institutional owners. We have no mandates. We've got, I'm able to answer whatever question you guys want to ask me today without fear or favor. And that's frankly, it's a really unusual thing in finance, right? So that's the base of the Motley Fool. Been in the US since 93, as I said. We opened here in 2011 because Australian investors and New Zealand investors, it turns out, are pretty much the same as the Yanks. They are investors who like doing it themselves, can do it themselves. The companies are reasonably understandable. We understand what it's like to own shares and have a little bit of extra risk in our portfolios. And so it just made sense to take that business, and we kind of Australianified it a little bit, and maybe we should Kiwify it a bit too, to make it suitable for our members, but kind of the same business there as here, trying every day to help individual investors invest and do well in the stock market.
Awesome.
Yeah, cool. What a cool to hear the backstory of the Motley Fool, actually. And as you were talking about it, I was thinking it's really similar to our mission at Sharesies and why we started Sharesies around this industry that is quite inaccessible, and then how can we make it more accessible? And that's a big part of why we do these lunch money webinars, actually. And as we talked about earlier, we've now created access to Australian shares, and we're really keen to get in and ask you some questions about this. So if you asked, we're starting, now our customers are seeing thousands of companies listed on ASX. So can you tell us a bit about, what are some of these key industries that these companies are in Australia?
Fantastic. Really good starting question. So the thing that probably you need to be mindful of, and I don't really know the Kiwi market as well as I should, but in Australia, we have a very concentrated market in a couple of key sectors. And so the companies that move the ASX are the banks and the miners. Now we have four big banks. You probably know their names: the Commonwealth, Westpac, National Australia Bank, and ANZ. And then a whole lot of little non-bank financial companies, insurance companies. They make about a third of the ASX by market weight. And market weight here is just all the shares added up, multiplied by the share price. And if you rank those and add them together, the banks are about a third of the total value of the ASX. Resource companies, and again, think about Rio, BHP, Fortescue, and others, are about another 15 to 20%, depending on where the commodity prices are at the time. And so those together are about half the market. And that's good and bad. It's bad in the sense that if you want diversification, you're not going to get it by buying an ASX ETF, unfortunately, because I love broad-based index ETFs, but you're not going to get super diversification by buying one. So they're the big two. On top of that, our other large companies are Telstra, a big telco. We have big supermarkets. Australia's like the country of duopolies, by the way, or oligopolies. Oligopoly is just monopoly or duopoly times 2 or 3 times. We've got 4 banks. We've got 3 miners. We've got 2 supermarkets, a couple of telcos. So the 2 big supermarkets are Woolworths and Coles here. And then we've got a couple other cool businesses like CSL, the blood plasma and immunization business, Cochlear, the hearing implant company, and a few other big ones. But that's kind of the big end of town. And then there's a whole lot of small and medium-sized companies. And broadly, for most investors, that's where the opportunity is. And it covers everything from retail to IT to mining, utilities, infrastructure, plenty of companies. And we can get into some of those in a bit more detail if you want later. But broadly, that's kind of the market. And for most investors, normally speaking, I love ETFs. I think they're great. I mean, I'm an individual stock investor generally, though I own some ETFs as well. But generally speaking, I love big ETFs, but the top end of the market is really, really concentrated. And one of the phrases I don't know what you guys think about this. I don't like the term blue chips, right? Because it's one of those broker terms that says, hey, don't worry about it. It's called a blue chip, so you can turn your brain off. Just buy it because it's called a blue chip, right? Which is crazy. And it's generally the case that blue chips are going to give you a worse result, particularly in the ASX, than looking for some of those small and medium-sized companies. I think that's where the real opportunity is. And they do really cover the waterfront: energy, utilities, mining, tech, consumer staples, consumer discretionary, all that stuff. Plenty of those to be found, but you do need to look a little bit further below the surface than just the top 20 or so ASX companies.
Yeah, cool. And so just, I know you kind of summarized it there, but just to tie it up, we'll do a jargon bust on so how was a blue chip described?
Great. So
What is
that's an awesome idea. So the idea of a blue chip, it's kind of one of those terms that's supposed to signify quality and strength and longevity. And that's kind of true to some degree. But some of the greatest Australian blow-ups or company collapses of recent years have been those so-called blue chips. They're the ones that, when the broker said, hey, just buy some blue chips, everyone goes, oh, yeah, of course, that makes sense because it's a blue chip. And it's loaded up with so much jargon, and it should be right, it should be true, and I'd love it to be true, to be able to say, those are the safe companies to buy. They are the equivalent of maybe some of the US companies. Think of some of the businesses of yesteryear, the Fords and General Motors, or the General Electrics, right? Those businesses are supposed to be the foundations of society, the big institutions. They're just not anymore. Or they are, but the share price have already caught up. And so the blue chip idea is it's inferred as quality. Don't think, just buy. What could possibly go wrong? The answer, unfortunately, is a lot, and both in terms of company quality and strength, but also, frankly, share price-wise, right? If everyone's already buying them, there's not going to be much opportunity for share price appreciation in those businesses if they're already fully priced because everyone's already in them. And so it's easy for a broker to sell because it's the easiest sell in the world, right? You've turned up some little old lady and say, hey, buy some blue chips. She said, I suppose I should. You got to dig below the surface. Any little old ladies watching? I'm not talking about you, I'm talking about the other ones. The idea of basically looking for the best opportunities you can, not just accepting the term blue chip because it's expressed that way.
Yeah, thanks. And so if we take a step back, what are you seeing in the Australian share market at the moment? Are there any trends or investing behaviours or certain industries that you can give us a bit of a lay of the land?
Yeah, this is fascinating, right? So when we talk about the ASX, we talk about the market, right? We talk about the ASX, same as we would with the New Zealand Stock Exchange. And the problem with that is you look at the index number, and as I said, you're basically getting half of that number made up of banks and miners. And so we say, how's the market going? You're really asking how are the banks and miners going. So let's drill down. The banks have had a really great 30-odd years up until about 2016. Australian banks have made an absolute fortune for a whole lot of people. So if you ask any investors of a certain age, maybe people with a little less hair than me, or about as much hair as me, they will say to you, the banks are great places to invest. Look how much money I've made. Look how much money they've made. Look how successful the banks have been. All true. But that's looking backwards, right? The last 5 years, in fact, from 2016 to 20, they'd lost 25% of their share price over that 5-year period, while the ASX went up 20%. So they're actually behind by about 45%. The banks are struggling now because they are really concentrated. There's not much growth left. They can't really gain much market share. GDP is not going to grow phenomenally fast. House prices are on the march. That's a conversation we get into in a minute if you want. But where does the long-term growth come from a banking sector that's already effectively dominating the entire market? And I don't think much. So they're big, they're dominant, they are the blue chips that we talked about, but I don't think there's much in the way of market betting opportunity left for those guys. In Australia, we have dividend franking or dividend imputation. Basically, it means you get credit for the tax paid by the company on that dividend. That makes them really popular. But again, I think too popular and probably unreasonably popular. So they're there, they're big, but they're probably not great investments. The miners are doing spectacularly well right now. If you think about the way that the iron ore price is now $200 a ton, something like that, our miners get it out of the ground in Western Australia for about $15 to $18 a ton. If you do that maths very quickly, that's a gross margin of about 90%. That is unheard of, literally unheard of in iron ore. They are better than software margins, which is great, except if you think we're already there, how much upside is left versus how much risk there is if and when volumes increase, prices fall. So I'm very mindful, very nervous about the iron ore space in Australia right now. I'm not generally a minerals investor. They don't tend to be great companies generally because they're selling commodity products by definition. Times when they get massive price increases like now are really, really rare and normally unsustainable. So I don't have a short-term view. I'm not a short-term investor. We don't do that at the Motley Fool. But long-term, I'd be very concerned. I don't think you're going to get great returns owning iron ore from here. So let's put those two aside. Then you've got retail, both staples, so the supermarket type products, and discretionary. And there we're talking about the items you don't have to buy, right? They're discretionary purchase. Think fashion is a great example. Tech, as in tech purchases. So think about some of the technology retailers, that kind of stuff, home furnishing retailers. Staples is really overvalued in the Australian market right now. You're paying about 28 times earnings for Woolworths, and I'm not sure what the averages are in New Zealand, but in Australia, the average price earnings multiple, which is the price of the stock divided by the profit per share, that's about 16, 17 times. So if you're paying 28 times for Woolies, and it's not going to grow very fast, then it gives you a sense that maybe it's overvalued. Coles is the same. There's two big retailers. So the opportunity is in the other companies that are left behind. I think there's some really good opportunity in consumer discretionary right now. I think there are businesses there that are growing really, really nicely, and we can talk about some individual stocks if you want later. They're doing really, really well. That's really nice. Tech is a bit of a barbell kind of scenario. There's a lot of really super expensive tech that everyone loves, so it's expensive. And there's the left behind stuff. And there is some left behind opportunity there, but you've got to be careful. I'm not a thematic investor. I don't buy sectors. I don't buy entire groups. I don't normally have a forecast or review on an entire sector. I'm more likely to pick bottom up, and that's where there's some value in there as well. Utilities reasonably okay, well priced, that kind of that average price. So I'd be looking in the consumer space in particular, or some of the left behind tech, if I was looking for opportunities in the Australian market.
Thanks. And so you touched on it, but a bit there, but around the volatility in the share market over the past year or so.
Yeah.
And, this was going to be about like, how does this compare with the ASX, how that's performed historically with the little, I think there was the announcement around how the share market was recently named, well, the Australian share market was recently named as delivering the best returns to investors globally over the past 121 years, was it? So just want to, can you give a bit of an overview on that?
And so I'm glad you said it, because I don't have to brag them, which is always like that. Right, so it turns out, actually, Australia, we're pretty good now. So yes, a Credit Suisse report actually came out about a month or so ago, and that was exactly right. The ASX had been the top performing share market since 1900, and not by heaps. And it's not really an arms race necessarily. It doesn't really. I mean, we all love being first, right? We all want to wave the flag where we can. But the ASX has generally delivered about a 9-ish% return annually. That's before inflation, and that's compounded. So if you think about what that does, for your viewers and listeners who may know the rule of 72, that's an old compound interest kind of trick, where you take your return, you divide it into 72, and you get what's left is the number of years it's going to take. So if you get 9% a year, you'll double your money about every 8 years, generally speaking, before taxes and stuff, and no guarantees, and all the disclaimer you said at the beginning, Sonya. But that's been a really good return. It's been the best return in the developed world, literally in 122 years, which is pretty good. The last 12, 14 months, I'm sure it's the same in New Zealand, has been a remarkable ride. The share market in Australia fell 38% between the 19th of February and the 23rd of March last year, the fastest bear market in history. And then recovered almost all of it. In fact, if you include dividends, we're already back above that level. The economy's out of recession. We can talk about the economy as well if you want. But the market, so look, the last 40 months has been remarkable in a whole lot of ways. The size of the fall, the pace of the fall, the size of the recovery, frankly. I don't think anyone would have expected on March 23 last year that we'd be where we are today, which is pretty much back. We're above where we started last year and not too far away from those total highs. So that's kind of the story that we find ourselves in. Again, it's really important. If you look at the NASDAQ and the S&P in the US, they've recovered far, far better and faster than the ASX. And it's largely because of that concentration. Banks can't grow that fast. And so that's why I want to say to people, if you look at the ASX as a group, it's absolutely reasonable to do, and we should. But I actually think that underplays the opportunity in the rest of the market outside that top 20, where the growth really is. Because if you're the 200th biggest company in the ASX, you can double your share price, and it'll have almost no impact at all on the way we talk about the ASX's level. The ASX 200 is our benchmark index. It'll have no impact because it's just so small. BHP alone is something like 7 or 8% of the index. It's our largest company. The little tiny tittle at 200, it can't impact the total return. So even if you owned some of the great small Australian companies, you could double your money without the index even moving. So yes, it's important to look at the index itself, and you're right to ask Sonya, and again, I'll mention best market 122 years. But it's also really, really important to not get caught too much in those totals and those summary levels, because it doesn't necessarily, I don't think, demonstrate the opportunity for investors for investing in some of those other businesses as well.
Awesome. I think you touched on it just before, the economy. Yeah, we're really keen to hear a bit more about the Australian economy as well. So yeah, taking a step back at a higher level, what are you seeing in the Aussie economy, and what should we be keeping our eye on in the short term and in the long term?
Look, I do a few media spots, and there's nothing better right now. I'm an optimist by nature, right? So I always say that up front to people, because if I give you a positive view, I'm an optimist. So I'm the person who's going to be still saying I'm going to be optimistic right until the day before the next recession, right? So for all the doom and gloom, I'm going to be the guy saying, remember, the long term is positive, the long term is bright. It always has been. I think it always will be. No guarantees, of course. We can't do those as financial advisors or planners, but I expect the long term to be really bright. So I'm an optimist. That being said, over the last 3 months, it's just been really, really great to do these sort of media spots where people say, hey, so tell me about unemployment. Yep, it's down and down a lot. Tell me about GDP. It's up and up a lot. All consumer confidence is up, business confidence is up. Look, to be fair, when you're coming out of the sort of recession we had, where we had the largest quarterly decline in history, at least since records were kept in the 50s in Australia, of course, bouncing out of that, you can't help but grow, which is lovely. But the Australian unemployment rate is about as low as it's been for most of the last 40 years. It's been lower in part, but 5.6% the last set of numbers were, which, again, depending on your own frame of reference, I'm not sure what the Kiwi numbers generally tend to be, but that is about as low. I mean, it's lower than it was through my entire childhood. We occasionally get under 5%, so we're on the way there, but it's really good and improving, which is excellent. Consumer and business confidence is really strong. And that, for me, that's my favorite economic, as an investor, as an economy watcher, confidence is my favorite economic indicator because it tells you what's going to happen next. If businesses feel confident, they're going to invest in equipment, they're going to hire people, they're going to try and grow. If consumers are confident, we're going to go and spend. We're going to go and expect things to get better so we don't have to keep the money in the wallet or the purse. We go and spend that money in businesses around the country. Combine those two, consumers feeling great, businesses feeling great, it really does underpin economic growth. And so that's I'm really, really encouraged by that. Unemployment, as I said, falling. The inflation rate here came out yesterday, still really low, probably a little bit lower than it should be. The good thing for Australian borrowers in particular is that means interest rates here are going to stay low for a very long time. The official cash rate here is 0.1%, so about as close to zero as you get without being zero. And you can get a fixed term home loan here for about 2%. So those things are really positive. Look, it's easy to be positive about the economy coming out of a recession like that, but all the indicators are going exactly in the right direction. I can't think of a single indicator that's in a bad place. Maybe inflation could be a little bit higher to suggest the economy is kind of getting back on its feet. We don't like inflation as consumers, but at an economy level, it's a little bit good. And expectations were for 1%. So if I want to give myself or us a black mark, it's probably that inflation isn't recovering as quickly as we would have liked. Other than that, the economy is looking really good and doing really well.
Yeah. It was something else in New Zealand we've been thinking about economy-wise is the opening of the Australian-New Zealand travel bubble as well, with tourism being such a sector for us. It's hopefully a nice tailwind for a lot of businesses here in New Zealand.
Totally.
Yes. So something you kind of briefly looked at before was the government and the Reserve Bank in Australia introducing low interest rates. So you talk about a lot of responses. Another thing we're seeing over here in New Zealand, and interested to hear about in Australia as well, is the house prices and how they're moving.
Yeah, that's a bit out of control, quite frankly.
Yeah.
Here's the thing about house prices. So I've been on record as saying I don't think the house prices are necessarily that expensive, and people then fall on the floor and have to pick them up and cool them down and then explain what I mean. The problem, so if I'm talking rationally, financially, mathematically, right? When rates go down, asset prices go up. It's what's supposed to happen. It's what the Reserve Bank expected to happen. It's what the economists tell us should happen with financial assets. The problem has been that the question remains socially, and for the society at large, should housing be considered a financial asset, or is it a lifestyle asset? Is it shelter? And so that we don't have time to go into that stuff. I'm happy to come back and do a whole section on that if you like. But broadly, so that's a different question. But while house prices are going through the roof, affordability, which is measured as repayments as a percentage of your income, aren't going up. In fact, houses have never, last 10, 15 years, have never been cheaper in Australia on an affordability measure because the prices have gone up. Why have they gone up? Because rates have come down. And when rates come down, we think we can all borrow more because the bank tells us we can. So it's kind of a bit of a self-fulfilling prophecy, right? Rates come down. You don't go to the bank manager and say, how much should I borrow? You go to the bank manager and say, how much can I borrow? And she says, well, you've got this much income, you can borrow this much at 2%. Great. Okay, I can buy $1.5 million house. Thank you, bank manager. I'll go and do that. Whether that's a good idea, open question. Whether you should do that, whether the economy or the society should have that, different question. The problem I have, or the watch out now, though, is that because housing has become a financial asset in the truest sense, it will go up and down. And Australians aren't used to house prices going down, right? We've spent 50 years effectively house prices going up or sideways, occasionally down by a bit for short periods of time. But as and when rates go up, because we've made it a financial asset, house prices should, and I can only imagine will, go down. And a lot of Australians won't be ready for that. So I'm not super worried about the affordability question. I think the ticket price is kind of, it's the result rather than the input, right? It's just a question of how much can I borrow, at what rate, what does that mean as a price? It's kind of like, it makes mathematical sense. But the real watch out, I think, for the economy and for individuals is, but when rates go from 2% to 4%, when house prices come down from, $1 million to 800,000 or 700,000, that's actually going to hurt a lot of people. Both literally, there'll be defaults and foreclosures. There'll be the wealth effect or negative wealth effect of I feel poor now because my house is worth less. So I think there's a reckoning in terms of the emotions and the reality of owning houses that I'm not sure that I want housing to be a financial asset, really kind of philosophically, but it's become one. And in that context, that's probably what the outlook looks like. If and when rates start to go up, we should expect downward pressure on house prices. And that will be something of a shock culturally and financially for Australians.
I think, housing, we're seeing the same thing here around housing, and housing is definitely, you've touched on an interesting point around whether it's a financial asset or a lifestyle asset, and might have to get you back for that conversation.
I will say, by the way, your government has done a much better job than ours at taking heat out of the market. I think you guys have done a really, really great job. I don't know how politically controversial it is to say, by the way, from the outsider looking in, taking steps to make sure we don't over-financialize, if I can use that term, housing. A lot of Australians looking at you guys going, yeah, we should do that too. And at the moment, our central banks and government don't want to. Again, I'm not sure if that's a controversial statement to make for your audience, but if it is, my apologies. If it's not, that's how it looks from the outside.
Oh, well, thanks for that. And so if we jump into some other questions, what are some of your tips and tricks for people who are choosing, what to invest in? How should people go about or think about doing that?
Yeah, I mean that like speaking of, I need another hour for that one alone, but I'll try and condense it down. So here's the thing. Try and get in order. First thing, you're buying businesses. You're not buying shares. You are buying shares, but you're not buying pieces of paper. You're not buying charts on a screen. You're not buying 3-letter ticket codes, to use the jargon. You're buying part share in a real business. If you're buying shares in Woolworths or Chorus, you're buying shares in individual businesses, and you should think about being a part business owner. And the more you can do that, the better set up you are for long-term investment success, because you're not going to be whipsawed as much by share prices. So that the first thing is own businesses. Second thing is be long-term. Set yourself up for a long-term result. If you can avoid it, as much as you guys are a share trading platform, please don't look at your share price all day, every day. Like, just turn it off and go to something else. Go for a walk, go to the shops, go play golf, whatever is your thing. Buy the businesses, buy shares in businesses, and leave them alone. Let them do their thing. You've got employees now who are there at literally the literal or the metaphorical store every day doing their thing. You don't need to keep an eye on them. Just let them do their thing. Go. If you bought the business for the right reason at the right price, let the thesis play out. And we've got so many examples of some of the services, we've recommended, where the short term has either been negative or flat, but over the long term, we've made a lot of money for our members. Some of them have sold out after 2, 3, 4 months. Oh, the shares are down. What are you guys doing? I thought you were supposed to pick me shares to go up. Now, we make mistakes all the time, by the way, but these are long term. So think long term as an investor. Thirdly, be diversified. Please buy a broad range of investments. If you just buy shares in one company, that company might go great, might do terribly, or somewhere in between. But as an investor, if you're going to be successful over the long term, you want a diversified portfolio. So one set of risks doesn't impact your investment success more than they otherwise should. By the way, for Australian investors, when they, a lot of Australian investors own more than one bank, and they say, I am diversified, I own all 4 banks. I'm like, guys, that's not diversification, can I tell you? That's so you're looking at not how many companies, but how many different types of risks am I exposed to? Is it local versus global economy? Is it interest rates? Are you exposed to interest rates more than you should be? Are you exposed to business lending or bad debts? So if you think about the levers that make your company successful or not, and think about how different are those across the different groups, that's a really, really important thing. Different sectors. If the telecommunications sector does well, but banking does terribly, or mining does well, but retail does terribly, again, having that diversification is super, super important. So as you think about constructing a portfolio, there's some great things to look at. When I get to individual companies, and again, stop me if you want me to break this up, but if I think about individual shares to buy, individual companies to buy specifically, in fact, when I talk to our members, I try not to say buy Woolies shares. I'll normally say buy shares in Woolies. Kind of the same thing, right? Except it's not, because what I'm trying to all the time say is make sure you're buying shares in the company. You're not buying shares, you're buying a share of the company. Same thing, it's semantics, but it's a really important difference. The other thing I do is I chide my guys every now and again. And when I say guys, I mean that men and women, guys as a group. Regularly, if anyone ever uses a stock code, a 3-letter ticker code in one of our meetings or on one of our Slack meetings, I always, in mock question, say, I didn't know what's that company? What's the company WOW, which is Woolworths share? I've never heard of that company. And someone says Woolworths, and someone else taps him on the shoulder and says he's having a go at you. And again, why? Because if I think about a company as its 3-letter code, if that's all I think about, Fisher & Paykel, healthcare, for example, a New Zealand example. If I think about FPH, then it just becomes FPH, which has a price and a chart and stuff. But if I tell myself, again, it's semantics, but if I use the business name over and over again, then it reminds me that I'm investing in the business itself. So when I'm buying businesses, I'm looking for a range of options. Not every business ticks every box. I'm looking for brand strength. That can be consumer brand or business brand. It can be. The question really is, how valuable is this? How likely is this company to be in the consideration set for its potential customers? Do they know it? Do they like it? Do they believe in it? Does it have a good reputation? That's super important. Management quality, really important. How good are these people? Hard to screw up a really, really, really basic business, but you want good, capable, honest people who act with integrity and candor, which is really super rare, by the way. If I only invested on that, I'd own probably 2 shares, but the more candid your management, the better you're going to be, because you're going to know what they're doing, why they're doing it. And also means they haven't got much ego. If they spend their entire lives making themselves look good, you can pretty much assume that's their focus, right? Rather than actually running the business. So that's important. Management is really important. You want a business that's resilient. We've seen through COVID, right? If it's got too much debt, you're on the risk of going broke at exactly the wrong time. If it's got a customer base that has 1 or 2 customers, a really big business, some do, by the way, they have 1 or 2 customers. Again, one of them walks away, guess what? You're in trouble. Think about the food companies I mentioned before. In Australia, Coles and Woolies have 85% of the food market. Now, if Coles or Woolworths delete your product, you've halved your sales. So you want to be careful with that. Your suppliers, again, supplier concentration. How many suppliers do you have? If one supplier walks away or puts the price up, do you have those choices? So resiliency is really, really important when you're looking at those businesses. And then I want long-term growth potential. So if you're buying a business and it's not going to grow very fast, you've got to get your pricing really, really, really right. If you're doing valuation of a slow-growing business, if you're out by a little bit, you can't make that up with growth. Growth covers a lot of valuation sins, but if it's not there, the sins are going to be exposed for everyone to see, and for yourself to see. Not that it's about everyone else, but your results. If you get a business with lots and lots and lots of growth, I own some growth business. I mentioned one outside the ASX, Amazon, business I've owned for a very long time. It's going to grow for a very long time to come. And, I bought it at what was traditionally a high price. I was making almost no money, 1,000-time PE, that sort of stuff. But because it's got so much growth ahead of it and for so long, you can afford to pay high prices for those businesses, and they tend to grow faster than the market expects. And that often means they're undervalued, and you're very good chance of doing above average gains.
Awesome considerations there. And I love the idea of thinking of yourself as a business owner and making that decision. For people looking at how to get the information to make those considerations, I'll say I listen to the Motley Fool podcast and find that a great source of information. Do you have any other places where people can go to find out those pieces of information to make the types of considerations you've been talking about?
Yeah, that's a really, really good question. And it's an extra degree of difficulty when you're moving outside your home market, right? Because we all know, I don't know your supermarkets as well as I know ours, for example, or your banks. And so if I was going to do the same in New Zealand, I'd have to ask the same question. So it's a really, really good one to ask. A couple of ways you can get reasonably easy access to that sort of stuff. Believe it or not, one of the first is the daily newspapers. Often they're available online, often for free or for a reasonably low subscription cost. It gives you a sense of not only the business news, but the actual kind of the general news. And you have to read all the articles about everything that's going on, but it gives you a context for what's actually happening in a market. And you'll see the company's names mentioned, you'll see the interactions. It's a really good way to get the lay of the land. If I was going to invest in the US, for example, the first thing I do is grab a copy of maybe the New York Times or Post or something, LA Times probably, and just kind of get familiar with what's actually going on in the country. And that sounds very uninvesting-y, but that's kind of where the decisions are made, right? Investing isn't as hard as it sometimes is made out to be. So knowing what's going on, what's happening, where the trends are, even like who's advertising in those papers gives you a really good sense, by the way, of kind of where some of the opportunities might be. So that's the first thing. Second thing is go to the ASX. The ASX company presentations are pretty good, and you can get them for free on asx.com.au. Has all the company presentations and announcements. Be a little bit careful. Most companies are trying to spin you. They're trying to convince you of all the good stuff. So always read it with a bit of a cynical eye, a bit of a skeptical eye. But you will get a sense of the growth rates, the competition, the suppliers, the customers, that kind of stuff. Companies will give you a lot of that information outright, which is really, really great. It's an easy way to kind of get your head around some of that stuff. And again, if you are super interested in a particular industry, some of the trade journals can give you a bit of an insight into some of those things. Some of them are available for free. Some you have to pay for. But the deeper you want to dig, the more it is to look at. The other thing I would say too is you guys know the New Zealand market pretty well. And I would say there's a lot of analogs between different countries that you don't necessarily have to start from scratch a lot. So if you understand the business model of supermarkets or banks or insurance companies or telecommunications companies, then you kind of can take what you already know and apply it to a new market. You've got to fill in the blanks. Dominant market share player is X. Growth competitor is Y. Dynamics are Z. Whatever those things are. So you do have to do a little bit of extra work, but you don't have to start from scratch the way you might think you have to. Sometimes taking that model and applying it to a new market is as simple as saying, right, I know how this thing works. Let me see what differences and similarities there are. And you'll find you go from 0 to 100 pretty quickly, and you're in a pretty good place to start making some good investment decisions.
Cool. Gus, is it time for some Q&A?
Time to open up the floor. Okay. Scott, so we've got one from Tony here.
Quick swig of Coke and we'll get on with it.
Tony, you kind of touched on this before, but are the mining and natural resources sectors likely to be volatile in their future?
Everything's likely to be volatile. So yes. Look, I don't do near future. I got to say, I don't do forecasts. I often say that people who forecast are either lying to you or lying to themselves or both. John Kenneth Galbraith says it much more nicely when he says, pundits forecast not because they know, but because they're asked. I think that's a really, really nice reminder, right? So near future, no idea. Medium to long term, here's the problem with resources companies. They are selling, the word commodity is literally, we call iron a commodity. Commodity means completely substitutable. No pricing power, no brand power, nothing to differentiate itself from. So if you guys are mining iron or I'm mining iron ore, we can sell to the same customer. They can take mine or yours, doesn't make any difference. That generally means not much pricing power and normally very low margins. Now, iron ore is a dramatic exception right now. But if I'm looking down the pike, the history tells me that generally speaking, prices always revert, or always have reverted, to about the cost of production plus a little bit. Now, if you're mining for $20 a ton and you're selling for $200 currently, and history says pricing normally comes back to cost, that's not a great place to be. So I don't buy commodities players generally. If I was going to, the time I would buy it is when the price was as close to cost as it's likely to get, because then you've got smaller downside potential. It can always go lower. You can always make a loss for a while. But generally speaking, the lower the commodity price is relative to the cost, the lower the risk, and the better the potential return if and when that price goes up. So I was going to do it. That's when I do it. I don't think I ever bought a mining company. Maybe I will at some point. But I'd only buy it when that price was low, because that gives you the maximum upside if the price rises in the future.
Makes sense. What is your opinion on investing in industries that rely on fossil fuels?
Oh, this is a big one, isn't it? Man, okay. So on behalf of our members, I don't make ethical investment decisions. Ethics are personal, and so we don't try to apply any ethics to anyone at all. I have my own issues on ethical investing, which I'm happy to touch on separately, by the way. But you asked about fossil fuel industries. I want to look into the future and work on. So separate this out. So if you don't want to invest on ethical reason, don't do it. So let me assume that you've said, okay, that's not an issue for me. Now I'm wondering, should I do it? You want to look at the asset base, how long the asset base will last, and factor in the case that they may actually not be able to extract all of those assets. For example, a whole lot of coal miners in Australia, there's more resources, more reserves in those coal mines that is likely to be able to be extracted without government policy or consumer decisions that say we don't want to do that anymore. And again, we get back into the politics of climate change at some point. I'm a believer in climate change. I think it's real. I think we should do something about it. Other people can differ, and that's fine, but I'm giving it to you straight so you know where I'm coming from. I'm not, as an investor, when my job is to maximize my returns, the question would simply be, hey, what if they can't get that out of the ground? What if policy changes? What if rules change? What if circumstances change and they can't? That's an existential risk for those people and those miners. So I'd be really, really careful about that. Oil might be slightly different. I don't see oil being banned in the same way coal will be. It's likely to be replaced by other fuels moving forward. If I had an oil driller, for example, with a decent ongoing production, and I could reasonably assess that, I think there's a decent chance we'll extract it all at higher and higher prices, by the way, over time. So I'd be less worried about that. But I will say I'd go straight back to the commodity thing. I don't own any drillers. I don't own any oil drillers, coal miners, for kind of the same reasons. They're commodity products, right? Look at the oil price. Over 100 and something years, the amount of oil we use has skyrocketed, and the price has only just kept up with inflation. So you kind of go, hang on, that doesn't sound like a great investment idea. Guess what? It's not. And that's exactly why. So ethically, haven't chosen not to invest because of ethical reasons. I haven't been confronted with that because I wouldn't buy them for commercial reasons. So the ethical considerations don't even need to be applied over the top. Does that answer the question?
That does answer the question. I hope.
Cool. Okay,
I assume it has anyway. That's a great answer. You touched before about how the management of a business is really important, and you touched around the candor specifically. I've got a question from Janine is just simply how can you assess this management quality? Where would you find that information?
Yeah, so a few different things. Firstly, track record. In a perfect world, the management would have been at more than one company because sometimes it's hard to separate the company result from the management result. If you worked in a telco in 2015 to 2018, you couldn't help but look like a genius because you made a lot of money. I think arguably that's more about the company than the management. So sometimes you get lucky or unlucky as a manager. What you want to be looking at, so firstly, if they've been in more than one company, that's useful. You want to look at their results at the time at the company. That's also useful. If they've been at one company or in CEO for one company, look at just their results straight out. Have they done a decent job? Look at their competitors as well. Have they done better than the competition? Because again, you're looking to find out where there are areas where they have been better than somebody else and try and work out whether they have added value or they have not added value in that circumstance. If rising tide lifts all boats, as Warren Buffett says, and so if that's just simply, if everyone's done well, then you want to give management a little bit less credit. The other thing to be careful of too is to be a little bit careful that they're not surfing the wave that someone else has created. I won't name any names, but there are some CEOs in the ASX who have done very well by simply having an easy act to follow. They've turned up after someone's either done the hard work, either done a really bad job, so they've been able to recover it, or has actually set the investments in motion that someone else gets to capitalize on. And so you want to be a little bit careful there as well, that you don't just pick the CEO who's just managed to catch the right wave, but is generally, to torture the metaphor, generally a good surfer and has shown themselves in low surf or bad surf, and again, better than the competition. So those are a few different ways. There's nothing beats, by the way, hearing from them directly. If you can watch interviews, read interviews they've done, and not everyone's a body language expert, but you're looking for, are they humble? Are they honest? Are they candid? Are they thoughtful? Are they just trying to sell and bluster their way through? Doesn't make them bad managers, but I'd rather have a manager who says, yeah, we screwed this up. We've learned from what we fixed it. Or, you know what, I made a mistake, but I've fixed it. Or, you know what, that's a really good question. I don't have an answer to that right now, but we're working on it. As opposed to the person who's there with they're doing the PR spin with all the words, none of the content. So try and just look through some of what's being said and try and just get really honestly. The other thing is I actually quite like would I want to have a beer with this person test. Not everyone who's likable is a good manager. Not everyone who's a good manager is likable. But generally speaking, if they seem like a decent, like literally just a stand-up person, that's often a pretty good sign they're actually just decent people, and that's a pretty good start if you're going to give someone some money, if you're going to invest in their company, you kind of want to be decent people. And as much as that doesn't sound very kind of high finance, here's the secret, right? The Motley Fool is based on the idea that high finance is kind of all the stuff they tell you it's all about. It's not really. It's about getting the basics right, and I think that's part of it.
Awesome. I've got two really quick ones because we're about to run out of time.
Oh no! All right.
First one, an interesting sector for growth. I think you touched on consumer discretionary before. What are a couple of examples of consumer discretionary companies?
Yep, give a couple of consumer discretionary companies. I own both of them. One is Kogan.com. They bought Mighty Ape, you guys will be familiar with just recently. Really good growth business run by Ruslan Kogan, the founder, who's also a humble guy. Like him a lot, like the company a lot. The shares are really cheap. They're followed by 2/3 recently. Will be volatile, but I like them. Adairs is a homewares retailer, furnishings, cushions, sheets. Their physical stores are growing really slowly, but their online business is going through the roof. If that can continue, they're at a reasonably cheap price. I think they'll be a good long-term investment as well.
Other question was that there's a dichotomy between the current pandemic and good results from corporates.
Yes.
Who is buying their product? Who is buying their products and services? How are they growing their revenue? And with people that might not have enough money to spend.
Yeah, nice. So look through the 2020 results and compare the current results with 2019 to get a real sense of the growth. So Coles, one of our biggest supermarkets, had a 6.4% sales decline year on year just recently. That's because last year they grew at 13%, and no supermarket grows at 13% consistently. So look at the numbers for this year, compare them to 2 years ago, and try and get a sense of what the general 2-year growth has been. It's a nice way to just try and quickly pull together there's more than just that, but it's a really good starting point to hang on. Are they genuinely growing, or am I just seeing the effect, plus or minus, positive or negative, of the pandemic, the end of the pandemic, that kind of stuff?
So Over to you there, Sonya.
Oh, God. Excellent. Well, that's it for today. Thanks heaps for joining us, Scott, and for answering all our questions and having just making this a fantastic conversation. We're really lucky to have you on the show, really.
That's been my pleasure. Thank you for the invitation, guys. I hope it's helped a little bit, get you a sense of the ASX. I'm super excited you guys are opening up for Kiwi investors on the ASX. I hope they enjoy it. I hope they make some good returns as well. And don't forget, we're the #1 country, 122 years.
It's a good little good little end note there. So we'll be back next Thursday, joined by Ralph Hynam, who's the CEO of the ASX listed company Volpara Health Technologies. We'll send a link. There's a link already there in the chat to join for next week. That's it for us this week. Thanks everyone, and thanks again, Scott. Ka kite.
Thanks all.
Yeah.